Welcome to the Daily Rip Live. It is Wednesday, March 5th. Shy, what's going on? How are you on this lovely morning?
I was doing better 30 minutes ago, but now the market is just turning on us. It's
What are you
about to go
looking at? What's
red.
standing out?
So I didn't love yesterday's. We had a bounce, intraday bounce. It was pretty explosive. My portfolio went from -6% to essentially up 1%. It's a 7% swing. That's wild to have in one day, but we gave up a lot of that bounce in the last 30 minutes of the day. So I was like, oof, that's not the great way to end it. And now we're seeing pre-market even after the Trump uh, shenanigans. To just say that, yeah, last night it didn't really help much, and it looks like the one level I was calling out on Qs, like I was like, if Qs stay above 496, I'm bullish. That's the 200. That's a 40-week SMA level. That's a key level for them to bounce off of, and that's been the trend since. That's been the trend since. Geez, since March 2023, they've stayed above that. So almost full 2 years. So if it breaks below that and that support turns into a resistance, that makes me think that we're about to enter a stage four breakdown. And that's when things can get really fearful because it's in price discovery mode now in a way of where's the near term bottom. And that's where capitulation happens. That's when the VIX spikes at 30, 40. And that's when a lot of people just like feel that fear and the gut feeling in the market. And I'm not saying we're going to get there, but I don't love the pre-market action right now. We're just feeding that, and we're below that 496 level. So that's something I'm going to be monitoring right at the open.
Yeah, I mean, the extended bull run that we've had since I think October 2022, it seems to be on notice. And the tariffs are obviously the thing everyone's talking about. Lutnick coming out saying, well, we might reverse some of them. There was a poll we put on StockTwits. 16,000 of you voted. 60% of you called these tariffs a market killer. Uh, okay.
Bro, I thought you were going to say something like drastic happened
I
in the
know. I
world
was like,
right
is
now. I was like, what
somebody
just
up StockTwits Nation? My name is Katie Perry. I'm here with Shay Boloor. It is Wednesday, March 5th, and we're going to run down the headlines with you today. Somehow it's only midway through the week. Shay, you're waking up. How are you feeling looking at these charts today?
I'm going to get defensive. I'm like, I was just mentioning it backstage where that I've been very vocal that 40-week SMA level on the Qs. Like, that's the level everyone needs to watch out for. And that's 496. We got right above that during power hour yesterday. Massive intraday swing. We feeded that move pretty aggressively towards the close. I was like, ugh. Pre-market, we were showing a lot of strength. I was like, okay, maybe this feels like another V-shaped recovery like we've been accustomed to the past 2 years. But now I'm seeing that 496 level that used to be a support turning into a resistance, and that's worrisome because it feels like the market's now going to be in price discovery mode because there is no more structural floor that we've been accustomed to the past 2 years. And when that occurs, money is lost there. And we're in a weird pocket where if that 496 level is the resistant, the next level of support I'm seeing is 460, and that's another 5 to 6% move. And I think there is going to be some level of capitulation in the coming days if we continue going lower and lower because there is no floor anymore. It feels unstable and people are going to freak out. That's just how the psychology works. So I'm what we got a little green right now, but yeah, I'm watching. It's gonna be a crazy open, and I think have some cash on the sidelines, have some dry powder because things could get wonky. It really could, and especially next couple months.
That just seems to be the theme lately. Every day seems weirder. And, the extended bull run we've had since October 2022, it's on notice now. And curious what you think, Shy. I mean, we talked a lot about tariffs. Lutnick came out yesterday, I think, and was like, well, maybe we're going to roll them back today or something. Is this going to be the thing that finally breaks the market, or do you think this is a confluence of factors at play?
So I think tariff issues were maybe call me optimistic, but I think they're going to ultimately sort itself out, and it's going to happen sooner than later. I think yesterday they even mentioned like today might be the day. The reason for that is I don't think people realize how the U.S. is essentially 20% of the global GDP. You can't just risk losing us. You can
Hmm.
like risk losing access to our consumers. You just can't. So there's gonna be negotiating. There's gonna be some posturing. There's gonna be somewhat of short-term noise. You call it disruption. That at the end of the day will be at the expense of the everyday Joe Schmo, Jane Schmo, and that sucks because U.S. citizens are gonna get uh, penalized from that, especially ones who have manufacturing in Canada, Mexico. Like they're gonna get like those short-term bumps could be fatal, and that's unfortunate to see, as because they're the government or Trump is using them as pawns in their game of chess with the world, which might be long-term gains, but the short-term bumps is fatal for a select few, and that's going to be unfortunate. But either way, I think tariffs is going to work itself out, and I just don't know when. Timetables, not nobody really knows when. I think we got the relief rally yesterday because the market doesn't like uncertainty. They hate it. We got yesterday. We got China, we got Mexico, and Canada rebuttal our initial tariffs. So now we had some level of a box of what the response is going to be like. So I think that's why I was okay. It's we now know what to expect, but I think there is some fear in the market still where we don't know how long this is going to go, and that combined with big tech clearly taking a breather from them treating this year as an investment year. CapEx is going to be more than expected. Their revenue acceleration won't match incrementally to what the expenses are increasing this year, and that's a bad combo. So the market's just looking for a catalyst to kind of bounce off of. And I will say the 10-year yield is dipping hard. The 4.1%. I think it was yesterday. I think we're at 4.2% today. I think we saw mortgage applications like skyrocket 20% in just the past week because of the lower rates. I think that's a good sign on demand, to be honest, for consumers of if things continue to get lower rates wise, like I think that we're gonna be fine. Like economically we are, but like you heard commentary from Target, you heard commentary from other massive
Yeah.
retailers that if tariffs are gonna come to play, we're raising our prices. And guess what? Boom, consumers
Yeah.
get hit again, and it's worrisome.
Yeah, it does get to a point where the political pressure starts to weigh on the economic strategy. I saw Brian Kilmeade, who's a Fox anchor, was tweeting about the tariffs in a negative light, and Maria Bartiromo had a segment on how trucks are going to be $20,000 more because that aluminum is going back and forth across the border. And so it is very real for a lot of people to see that. But I do think you're right in that it's unpredictable right now, and all we can do is sort of wait for the next move. And I'm curious what you think as well on um, the sort of the ability for the administration to sort of put pressure onto the system, and I don't want to say manipulate, but like actually cause things to happen in real time, and they're taking kind of a more active role in that. Do you think that creates less risk in the market? So if things start going really bad, they're going to turn around and go the other way because they're looking at those stock prices.
So I think I don't know. I think Trump doesn't care from first 2 months of his presidency. Like he cares a lot less than I thought he would about the stock market price. Like he's not making any kind of commentary at all about the stock market pulling back 8%. Like how often does the market pull back close to 10% in a matter of weeks? Like it's pretty rare. Maybe once, maybe twice a year. We just got that in the first 2 months of his presidency. No comments from him. So I'm
Mm-hmm.
like, that's interesting behavior. That's part A. Part B is he's shilling coins. His family's shilling coins. So maybe he's just making his buck, or his family's just making that buck in that crypto space, and the equity markets isn't as enticing for him anymore. He doesn't care much about it. He could just blame Biden if it struggles in the first year. Like that's just the status quo of a new presidency, new regime in the presidency. Where like if things struggle right out the gates, he can easily blame the prior captain of the ship. And maybe that's the move that he can make his buck in the crypto markets if equities pull back. Biden, Biden, Biden. But either way, like he is pretty tamed right now in his commentary on the stock market pullback, and that is surprising behavior. So I
Yeah,
don't know.
I mean,
I have less faith in him. Yeah,
he f-
in do
he fa- yeah, he famously tweeted that if the stock market drops 1,000 points in a session, that the president should be impeached. So that's our lesson to never tweet anything because you just never know. That'll come back. We actually polled StockTwits users on all of this. 16,000 of you voted, and 60% of you called the tariffs a market killer. And speaking of our StockTwits community members, we have actually a very exciting opportunity coming up. We are launching a new show called Exec Response, and it's basically going to be we're mining the internet for all of your comments about these companies and taking submissions in. So picture a hybrid of the mean tweets concept from Jimmy Kimmel and a fireside chat with a CEO. So it takes a really brave exec to come on. They're gonna answer candidly about all the shit you guys are talking online. And Affirm is gonna be our first guest. We're recording that next week. So if you all have questions, comments, feedback for Affirm, drop it in StockTwits, tag the company. Shay, I'm sure you have some burning questions. Do you wanna throw anything in there?
I mean, first off, kudos to the CFO for hopping on. He sticking your neck out is a tough thing, especially in the space they're working on. I am a bear on a firm. I've been a bear. As you guys are aware, I'm a thematic investor, investing 5+ years out. It's usually decade-long themes. Buy now, pay later is like I get the how it's fundamentally changing consumer credit, high interest rate credit cards with a more transparent and accessible alternative. Like I get the spiel of buy now, pay later. But the most glaring issue to me is what's the structural differentiation of buy now, pay later? The core services, like again, the ability to split payments into installments, and you can something that's virtually, I don't know, in every institution, payment provider or and merchants themselves can like they can easily replicate that. So like, what's the differentiation that a firm has that creates somewhat of a competitive advantage, some kind of defensible moat? Because unlike the credit card networks, which like the Visas, they Mastercards, they benefit from the network effects. So once they entrench their relationships with like these banks, the buy now pay later providers like their firms, like they just lack that same kind of lock in. So my question to him would be, it seems like your firm's in this perpetual race to secure partnerships with merchants who inevitably opt for the lowest cost provider. Like, is this a industry that's in a race to the bottom because buy now pay later is a commodity, or what makes them actually have a defensible moat? Because buy now pay later is thriving in a low rate environment. So like if rates cut, that's gonna be a tailwind. But let's just say hypothetically, consumer spending continues to dive, and people are gonna put more and more credit dollars on the credit because inflation is going to go up from this tariff war we're about to enter. Like, how is a firm going to be able to underwrite these models and sustain itself? And what makes them special? I really think it's going to hit their margins. So I know it's a loaded, vague question to ask a CFO, like, what's your competitive advantage? And I just wanted him to talk more about the thematic buy now, pay later than the actual company itself of saying like, oh, they just have great partnerships, like their first mover advantage, like all that stuff at Amazon, Shopify. Like I get all that stuff, but I want to hear structurally, why is buy now pay later a secular growth theme that's structurally shifting from what it used to be, what's going to become?
Yeah, I don't think that's a vague question at all. I got the opportunity to interview their COO, it was almost a year ago. And I had a similar question of it is one of those industries where you go to check out on a web page now and there's 8 logos and they're all the same size and they're lined up in a row. And
Mhm.
it's, how do you win in that situation? You're building the brand with the consumer, getting preferential placement with the merchant. I believe the CEO spoke to kind of the back end tech of how their systems work. That's harder to grasp for a lot of people. I think it would be great when we sit down with Rob O'Hare to talk about and break down like, okay, what is that tech advantage
Mhm.
in ways that people can actually grasp? Because I went to the same place. It's like, oh, I'll pick pick Klarna, click Affirm.
Yeah.
It doesn't matter. And there are differences, but it's hard to articulate those to the end consumer and also the investor who are probably overlapping.
Hmm. Yeah, I mean, I just don't see them as a standalone product. It's going to be something lumped into a ecosystem that exists already. Like Square acquired, I forgot who Square acquired, but it was a buy now pay later competitor. It was huge at the time, Australian company. I'm blanking on the name, but like I think, I don't know, that's the route our firm's going to go
Yeah.
down. I can't see them being a standalone.
Yeah. Let's shift over to CrowdStrike, which is a company you've talked about a couple times this week. They beat their Q4 estimates, but still slipped. Do you think investors overreacted to the soft guidance and outage-related costs? Maybe you could summarize the outage because I don't. It felt like a while ago. What went down and why is it still impacting the stock?
Yeah, so I mean, the outage was 9 months ago. It was a full pregnancy. It's kind of wild to say. I just think, yeah, the outage was just honestly an system update error. It's like it wasn't anything structurally affecting the thesis of the company and endpoint security or the Falcon platform. It was purely something as simple as an admin error. Let's just say that, and it could have been avoided if there was a structure in place already, which there should have been. And CrowdStrike's owning that, and that's the issue about why CrowdStrike's margins or guidance is getting hit because they are still like they're still providing temporary pricing concessions from that outage. Like even though it was 9 months ago, and even though you're seeing the stock pre-outage was, oh my God, yeah, pre-outage it was at 375. So it got, before today's earnings, it got to, I don't know, it got to 400. So like it's 10% higher than it was pre-outage. But I mentioned this on the stream, like the fundamental profile is drastically different. Even though the price recovered, their multiple expanded drastically because of these temporary concessions that they still have to give to the customers from effing up so bad. But if you look at a 10,000-foot view of this or like long-term thinking about it, this 70, $80 billion company shut down the whole world for a couple hours. And it showed how essential they are into the everyday like for the world to keep spinning. Like CrowdStrike's an absolute necessity,
Mm-hmm.
and also showed the highlight of like how important cybersecurity is. But I do think this whole entire drawdown that we're seeing, the 7%, it's 100% short-sighted. It's a textbook example of that because this is temporary concessions from the outage that caused the margin miss, and this won't exist in 6 months. You heard the commentary on the conference call where they expect a reacceleration second half of this year, and then they expect growth to reaccelerate on top of that into next year. That's indicating to me that these temporary pricing concessions is going to be temporary, and it's not going to be something that's going to be status quo for more than a year. And even during these margin compression periods, they just produce a Rule of 40 score of 56. This is the worst it's probably going to ever be for a CrowdStrike on, wow, we effed up. We have to give so many free products to satisfy. Like, they have to go full PR mode.
Mm-hmm.
And they're still reporting a Rule 40 score of 56. It's freaking elite. And I think the biggest call out for me as well was that reacceleration. They're anticipating it second half this year and even more so next year. And then you're seeing also they're no longer an endpoint security company. Their next gen SIEM business is now growing over 100% year over year, surpassing 320 or $330 million in ARR. And that combined with their identity protection side of their business, it's $1 billion plus ARR business just as a standalone. So these side projects aren't just side projects anymore. They're becoming the new pillars of enterprise security. So like that's why I'm mentioning, like referencing them as like the all-in-one cybersecurity platform, because they're not just they're the best by a mile endpoint security company, but you're seeing these different pillars of the company just growing like gangbusters, and it's becoming just a massive like company in that cybersecurity space that's only going to gain more and more of a necessity in the next decade from AI, like especially AI agents. Like AI agents are going to produce 100,000x more products because it's going to be a lot more streamlined. It's going to be a lot very easier. SMBs are going to be one person, so dozens. And what do you have to do with those products? And the data for those products, you have to protect it. Cybersecurity would be an essential component of our lives, and CrowdStrike's a tier one play. So I think that's why I'm minus 7%. I'm like, okay, it was expensive already. That multiple expansion I was referencing from pre-outage to now, like it did get way more expensive. But end of the day, this is one of those beach stocks, those tier one, stage two AI winners that has a high floor in any kind of dip. And I wouldn't be surprised. I don't know. I'm looking at their level. 21-week EMA is at 369. So we're below that. So the next level I can see is 330 to 340. But really, for me, I would probably even add at 320 because that's the anchored average VWAP from August 2024, which is the bottom of that outage. And I think a lot of new investors came into that stock from that outage pullback because they finally had the opportunity to get exposure in his name. So like I think 320 is probably a really strong floor on the stock, but like, I don't even know if it gets there.
Yeah, I think. By the way, if you can't hang out with Shy all the time and hear that amazing voiceover, there's an amazing feature now in StockTwits called "What's Trending," so you can actually see what's causing the movements. But of course, we hope you'll always tune in and listen to the lengthy response from Shy. We have some.
Long-winded.
No, it was great. You know your stuff on that one, and it's just interesting to dig down into like all the layers beneath it, below the headlines. Speaking of headlines, we have some breaking news in the jobs market. So ADP's jobs report just dropped. Private companies added just 77,000 new workers for the month, and that was well below the January number that was 186,000. And the estimate was supposed to be around 150,000. So that's a big miss. Kind of worrisome. Shy, what do you think about this sort of contraction in private hiring? I personally have a lot of questions lately of all these federal workers who are higher wage workers now competing in the private sector for fewer jobs. What does that look like? What does the sort of white collar job market look like to you?
So I'll talk from my anecdotal evidence. I think the days of teams of 8, teams of 10 is like no more. It's gonna be consolidating to teams of 6, teams of 5. I think you're hearing commentary even from like Amazon consistently that middle management is getting crowded. It just is, and it's like, what's the add value from having too many chefs in the kitchen? Like that's end of the day when teams become crowded and there's so many people at a certain level, it becomes inefficient to kind of have that many people at that level. So I do think you're also seeing AI tools provide a lot more of efficiency and streamlined initiatives at like right off like the graduates, like the early like the analysts out there, the managers. Do you really need like that many analysts anymore? Because you have to train them, you have to onboard them, like especially when you hire someone new. There's a lengthy multi-month process of getting them onboarded. That's that's not cost efficient at all. And to be honest, there's a lot of errors as well in the first 6 months, even first year of anyone's new job and a new position, new job. So like, I do think this employment change, I'm shocked to see a 50% miss. That's kind of alarming. I wonder if there's something government related to that, but I
Mm-hmm.
just think, I don't know, this trend that we're going to, I think workforce is going to be consistently reduced and reduced year after year after year. We're talking to replace all jobs, but I think there's going to be like by the end of this decade, there's going to be a close to 30 to 40% reduction in workforce in a lot of enterprises, like a lot of them.
Yeah, I mean, anecdotally, I see the same things. It was a lot of like good times for some of these bigger platforms, especially, and there was a lot of middle management making amazing money. And these companies had the cash. Like I just got lunch at Google last week, and they now serve you in the cafeteria with a waiter, and they got the money. But I'm like, this is weird. So yeah, I think it is like you need someone who can do kind of the thought work, the strategy to guide the new tools. But you don't necessarily just need someone to do the grunt work, and you don't need someone necessarily to just do the strategy. That can be merged into one. And the tool is now acting as like your
Hmm.
counterpart in that. But it is going to be, I just, yeah, I think about it a lot. A lot of these jobs have existed to, the role is to oversee the team. The role is to keep things on track. And like, increasingly they're flattening. And I think when you see like the big tech platforms that have a lot of cash doing layoffs, that's when I'm like, okay, because they don't have to.
Hmm.
And then when one starts doing that, they look around, the others are like, okay, cool, we can do that too. The stock rose on the news. So yeah, I think I agree with you though. I hadn't thought about the angle of, did the federal cutbacks impact the private sector? I think that's an interesting point because obviously
I,
they interplay.
I mean, a 50% miss. That's why I think it might have done that. Because like we're both talking about like a multi-year trend, like not like
Mhm.
month to month. A 50% miss feels like it's government related, and that might be I don't know. It's not a good thing, but I don't know. We can all agree it's very bloated. Any kind of government intervention, and I
Mhm.
think maybe it's getting a little tougher. But yeah, it's interesting times out there. I also think like it's a lot of people don't want to offer jobs when they see the environment evolving. Like AI is just beginning. They don't really know what positions they need it for it in a year
Mhm.
from now. So they want to hire currently and be stuck with a position that might not even be necessity in a year. They have to have a different kind of position. So don't I want to fear like make people super fearful. I'm just saying like jobs are going to evolve, and right now a lot of companies don't know what kind of positions they need in a year, 2 years.
I absolutely agree with that. I feel like that's probably reflected in the new job postings numbers because I've heard that anecdotally as well. Kind of need this, kind of need that. Like, how do you define that into a role when the
Hmm.
very nature of those roles are changing? And sometimes it's like they just don't post the job and they're asking around, and so it's strange times. I know we're coming up on the bell soon, but quickly I wanted to get into AST SpaceMobile. Shay, I know you're in the space sector. I've heard you talk about Rocket Lab a bit, Redwire. What do you make of AST SpaceMobile? How do you place these guys in the space economy?
Yeah, so AST SpaceMobile, if you guys aren't aware of what they do, they are essentially, I mean, I like to call them, they're bridging the connectivity from space to the world, clearly. But I think I like to call them the American Tower of Space. So I think the first thing you know about AST SpaceMobile is the fat partnerships they have. Like, they have the biggest partnerships in telecom. AT&T, Verizon, Vodafone, Telefonica, I always butcher this name, Rakuten or Rakuten. Regardless,
That's Rakuten.
is it Rakuten?
I don't
I think
know.
so. R A
That's one where
Q.
like you think you know, and then you say it, and you're like, that's not a word.
Either way, every big dog in the telecom space partners is partnering up with them, and
Yeah.
these aren't just handshake deals. Like these are deep structural integrations with what is going to make ASTS a core component of the global connectivity infrastructure. So like once a mobile network commits to ASTS, like switching to another provider would just be so complicated, so costly, and it's going to make ASTS not just like a service provider, but an essential long-term partner. And this logic kind of applies to the growing list of government contracts. Like there's going to be a ton, like its recent designation of a prime contractor for the Space Development Agency is a perfect example of that. So it's not just consumer connectivity. Like ASTS is securing a massive foothold in national security, and that has a lot of runway, especially in a Trump-led presidency where Elon has a ton of space exposure through Starlink and
Hmm.
SpaceX, and like high tide raises all boats. Like I think ASTS is like if they can deliver on the promises they have in their estimates, this is a $50 billion company in a couple of years, and that's why it's like whoa.
Yeah, it is interesting to see the maturation of the space economy because it is beyond launches. Oh, speaking of launches, we are launching into the market open. Happy trading, everyone. That always catches me off guard, and I don't know why I get a jump scare, but that happens. Quickly, before we turn to some other headlines, want to plug something real quick that is a very fun feature for all of our members of the StockTwits community. We actually just announced a partnership with Beehive. Beehive is a newsletter platform. They're absolutely crushing it if you
A
follow
late
them, the
integration in.
founders. They make it very seamless and easy to self-publish. So we're actually tying in with them. You can add a StockTwits integration. The cash tags you add to your content actually get pulled into your account on StockTwits and automatically distributes all of your hot takes right into our platform automatically as you're writing on Beehive. So if you don't have a Beehive, go check it out if you have a lot to say and want to say it, or if you're a Beehive writer already and you're on StockTwits, go to the integrations, plug that in. I did it yesterday. It takes 5 minutes. And that's a great way to get some of your longer form content and thoughts out into the wild. All right. Let's see what else is going on now that we are in it today. Valuations. I know, Shay, you pointed out some eye-opening PEG ratios for big tech stocks. Do you think these giants are overpriced? Do they have room to run?
Overpriced. I mean, look at this chart. This is a perfect example of like what I was referencing of like an investment year for big tech. So PEG ratio, it's Peter Lynch's like go-to metric. If you guys aren't aware of who Peter Lynch is, please look him up. He is like goats in the space. The best way to value mature companies, which is big tech, is on a PEG ratio. Or it's a price to earnings to growth. So like how much are they actually? What's their current valuation associated with how much their earnings are growing? Anything below is a one is undervalued. Anything above two is pricey and it's probably going to return towards the mean of two. Meta 4.3, Apple 3.6, Amazon 2.4, Microsoft 2.3. Like the half of Mag 7 essentially is pricey. And that's because they're sacrificing their margins to invest in as much AI tools as possible to not have that compute constraint anymore going forward so they can actually hit their max AI potential. But that's coming at the expense of shareholders. And right now, they're even though stocks have been pulling back like 8-10%, like they're still significantly pricey because their multiple has expanded because of that issue of lack of revenue acceleration and their margins are deteriorating. And you're seeing that's part A of this chart. Part B is like semiconductors. It's a cyclical business, fully aware of that, and I feel like we're in the middle of that S curve right now for the semiconductor space. But like that whole sector is in a bearish trend. It is ugly out there. They're breaking key levels that they have not done in years. So I think a lot of the market's a forward-looking mechanism. They're pricing in of like, oh, are the glory days behind semiconductors? Is stage one of AI behind is over, and like now it's going to be in digestion period, AI digestion period where big tech is going to start implementing ROI on their AI investment spend. If that's the case, you're not going to have those commentaries from the CEOs of like the risk of overspending is far greater than underspending. Now they're going to be a lot more strategic about it. And if that's the case, the gold rush might be over, and there's some fear of like the cyclicality risk associated to semiconductors. I think the market's front running that. So if that's not the case, holy moly, they're cheap because they're under one. And I think like Nvidia, it's a trading at 26 times their earnings this year. That's substantially cheaper than what they should be if they can maintain their momentum of growing at the pace they've been growing. But people are just like anticipating that's not going to be the case at all. And another commentary, I think Netflix is a little juiced up a bit because they're having a low hanging fruits on that password sharing like halt that there's like no more doing that. So like a lot of people are like adjusting to it, and then their ad tier subscriptions like taking off because of it. I think there's somewhat of a lower runway for that. I think the juice has been squeezed and it's a little inflated because of that. But yeah, I mean, this is a great chart just showing like even in a 10% correction in QQQ, there isn't that much buying opportunities in big tech. There just isn't.
Yeah, the chart's helpful for more of that. Definitely, if you're not already following Shy, there's lots of great visuals like that. I quickly want to jump to this news out of Novo Nordisk. So they just announced this morning they're going direct to consumer with their weight loss drugs, cutting their prices. I know a lot of people are fired up about Hims. We got a lot of Hims fan boys and girls in the crowd. Shy, what does this mean for Hims, who they've had a bit of a hot streak and a little volatility, but what does this indicate for them?
Yeah, so I am probably a notorious Hims bear. Sorry, guys. Uh, I just don't see it. I really don't. And the main reason I just don't see it long term is telehealth. I think the two pillars of telehealth is convenience and pricing. That's just at the end of the day, that's all it is. Price, like when you have bigger players like Novo Nordisk on the GLP-1 side of the business, and then other side is Amazon trying to get into the telehealth space. How is Hims and Her Health is going to be able to compete with them on pricing? They're not. I think their margins are going to be their 80% gross margins they have right now will not be there in a couple years. It's going to be at 70%, maybe even mid 60%. And because they need to have competing prices towards the Novo Nordisks out there, the Amazons, and I think that's how capitalism works. It's a brutal place to be in, but like that's capitalism, baby. And like in a telehealth space, that's a highly commoditized space. Hims and Her Health is exposed to David versus Goliath, and that's going to come at the expense of their margins. And I think that everyone in the world has Amazon Prime. Everyone, like it's like everyone has it. Like they can undercut Hims pricing like with ease, like such an ease. Like just put in it's in the ecosystem. So flywheel already existing in Amazon. Let's just undercut Hims. Clearly, they're first mover advantage. They're thriving with their market share in telehealth. Like we want some of that piece of that pie. So I think Hims and Her Health will do fine long term. They're gonna be part of this like ecosystem. It's just like their margins are not gonna be the case in a couple of years. Their market share is not gonna be this similar in a couple of years. And Novo Nordisk is a classic example. Like today's news, they cut the price 50%, 50.
Yeah.
That's not a casual cut. That's like we're cutting 50%, and that's gonna essentially slash all of the GLP-1 revenue for Hims and Her Health, which isn't that much of their business. It's not.
Hmm.
But I think the reaction to Hims and Her Health is this is symbolic of what could occur down the line for a lot of the bigger names as well. Like this is not just a one-off thing. This can occur across every component of their business. And if that's the case, this feels very teledocy on telehealth. Like they were at Teladoc was like $250 stock until became extremely crowded and the
Hmm.
margins got hit and their funnel profile looked drastically different and the stock went down 90%. I don't think Hims will go down 90%. I just think it's not people are calling it a mega cap company. I don't think it's going to be a mega cap company. I just really don't think so at all. But I'm in the minority in that. I could be absolutely wrong. I hope I am because there's a massive retail following behind the stock, and like I don't want people to lose their money. But I just don't see a long term thesis in this company at all.
Yeah, I think it is the David Goliath thing is interesting because it depends sometimes on like what the business is. I think example I hear a lot is why does Dropbox exist if Google has Google Drive, and there's places where okay there's companies focused on innovating in specific pockets and they can still compete against the big dogs because the big dogs aren't focused there. But to your point, like if it's an actual product that's the scientific there's the science of the product that exists as it is and then it's a distribution issue. I mean how are you going to compete with Amazon on the distribution? So that's definitely one to watch, and growing tam, ever growing tam really in that one. So um, look forward to more updates there. In the after hours today, we've got Rigetti, Marvel, or is it Marvell? It might be Marvell. MRVL, Zscaler, and MongoDB on deck. Which of those are you looking at, Shy? Which are you following closely later on today?
So I am following MongoDB very closely. So that's
What do
MongoDB
they
is one
do
of
again?
they're the NoSQL database. Let's just say that of
All right.
modern AI applications, modern applications. But eventually, they're going to be purely AI applications. So there's a heavy transactional components in that business where if things are running really well in business spending, in the it's going to run, and that's what we experienced in 2022, 2023. It just like ran. But when the spending is optimized, it suffers. And every engineer I talk to for MongoDB, they don't like the product itself. They just don't. They don't. Like there's better competing products, especially the Amazon one has a competing product, but I still think there's a place for MongoDB in the agentic AI world where you need unstructured data. Like it's an absolute necessity. And in their NoSQL database, like that's an incredible niche within a database ecosystem that's so massive. I just think they're gonna find a great like moat within that niche, and that specific moat and specific niche has a ton of runway in the agentic AI world we're about to enter, where every application is going to be essentially a modern AI one, in my opinion. And I think it's going to need unstructured data. It just has to. So I feel like even though engineers don't love their product, I'm hoping that the thematic itself just lifts it up enough where they can maybe create a more tailored version for that the engineers love. But I think the cloud agnostic component of it is actually massive. The fundamental profile would never look great because it's essentially offering they're sacrificing a lot of cash up front because it has such a sticky ecosystem. They just want as many customers and clients using them as possible, and they can worry about the cash flow down the line. But yeah, I just think that's one that's like it's a consumption model, so customers pay as you go. Data is about to explode; they're going to print cash, and you're seeing Confluent do well this cycle. You're seeing Snowflake do well this cycle. You're seeing Cloudflare do well this cycle. You saw Datadog do well, but they guided poorly. I think that's more of an observability issue, not really data consumption issue. But like lagging software names with a consumption model have been catching bids, and I think MongoDB could be one that follows suit as well. Other names, I think you mentioned Marvell. I think Marvell is going to do great. I really do think they're going to have a really strong earnings, very Broadcom like, very Astera Labs like. Their association with AWS again essentially I think cements in themselves that they're going to outperform. Like their Trainium chip is using Marvell, and their Trainium chip had a lot of momentum on their last earnings call. So I think they'll do well, but again, you have to ask what's being priced in or not. I did not know they're at $87. That's interesting. I might do a trade on after this. I'll look into Marvell trade. I think they're gonna do well this earnings report. Zscaler is the other one. So Zscaler is a frustrating stock. I think a lot of people had high expectations for them. They're fundamentally great. They are just an edge networking. I just think edge is like becoming more of a commodity, and that's my worry for Zscaler. Like I don't know if you can be a standalone in edge, and you're just seeing them not show that reacceleration that you'd want. And they have an incredible CEO, but it feels like this is going to be an acquisition name. But the weird gray area is Jay's family, the CEO, owns so much of it. Like I don't think Jay will ever sell, but I just think they have to figure something out because SASE is just not a good enough component of SASE by SASE. I don't think it's going to be a good enough like standalone in the cybersecurity space, and that is a little worrisome. But if I'm wrong, like this is a name that should catch a bid because it's been lagging for a while.
All right. Well, we're going to check back on all of those tomorrow morning, back here at 9 a.m. It looks like as we close out, the markets are kind of unchanged. People are still trying to figure out what to make of the jobs report, the tariffs thing, what Justin Trudeau is going to say, what whoever's going to say. We'll, of course, be watching it all, and we'll be back here tomorrow to break it all down again. Shay, I hope you have an amazing day, and thank you, everyone, for tuning in.
Thanks, everyone.